Today I'm going to review the difference between variable and absorption costing, part Dr. نبيه, cost accounting, third year. Before explaining the difference between variable and absorption costing, we should differentiate between product and period costs. Product cost for financial accounting purpose. Product costs include all costs involved in acquiring, merchandising company, or making a product, manufacturing. In the case of manufactured costs, these costs consists of direct materials, direct labor, and manufacturing overhead. Product costs are initially assigned to an inventory account on the balance sheet. When the goods are sold, the costs are released from inventory as expenses, typically called cost of goods sold, and matched against sales revenue, also called inventoriable costs. We want to emphasize that product costs are not necessarily treated as expenses in the period in which they are incurred. Rather, as explained above, they are treated as expenses in the period in which the related products are sold. On the other hand, period costs are all the costs that are not product costs. All selling and administrative expenses are treated as period costs. For example, sales commissions, advertising, executive salaries, public relations, and the rental costs of administrative office. Period costs are not included as part of the cost of either purchased or manufacturing goods. Instead, period costs are expensed on the income statement in the period in which they are incurred. Back to absorption costing. Absorption costing treats all manufacturing costs as product costs, regardless of whether they are variable or fixed. The cost of a unit of product under the absorption costing consists of direct materials, direct labor, both variable and fixed manufacturing overhead. Thus, absorption costing allocates a portion of fixed manufacturing overhead cost to each unit of product along with the variable manufacturing costs. Because absorption costing includes all manufacturing costs in product costs, it's frequently referred to as full cost method. Under absorption costing, the fixed portion of manufacturing overhead is absorbed into the cost of each unit of product. So the name absorption costing. Product cost thus includes all manufacturing costs, both fixed and variable. Gross margin, also called gross profit, is the net difference between sales revenue and absorption cost of goods sold. It represents the amount available to cover selling and administrative expenses. This method is required for external reporting purpose and for tax purpose. Variable costing are required internally. Under variable costing, only those manufacturing costs that vary with output are treated as product costs or variable manufacturing costs, direct material, direct labor, variable portion of manufacturing overhead only. Fixed manufacturing overhead is treated as period cost, and like selling and administrative expenses, it is expensed in its entirely each period. The cost of a unit of product in inventory or in cost of goods sold under the variable costing method doesn't contain any fixed manufacturing overhead costs. Variable costing is sometimes referred to as direct costing or marginal costing. The accounting for variable production costs and fixed selling and administrative expenses is identical under the two methods. The difference lies in the varying treatment of fixed production costs or fixed manufacturing overhead and presentation of variable selling and administrative expenses, as we will see in the comparative income statement. Again, absorption costing required under accounting standards. Absorption costing, product costs included in cost of goods sold. Under absorption costing, all variable production costs plus all fixed production costs. However, in variable costing, for internal reporting only, variable costing consists of variable production cost. Product costs under variable costing consists of variable production costs only. Variable production costs means direct material, direct labor, variable manufacturing overhead. Under absorption costing, direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So the difference lies in fixed manufacturing overhead. Under absorption costing, period costs include all variable selling and administrative expenses, also fixed selling and administrative expenses. Under variable costing, period costs include both variable selling and administrative and fixed, like absorption costing, added fixed production costs. So the difference between the two lies in fixed production costs. Fixed production costs included in product costs under absorption costing, and included in period costs under variable costing. Under absorption costing, some fixed costs are embedded in ending inventory, while under variable costing, all costs have been expensed. Therefore, when production exceeds the sales, that means there is an ending inventory, operating income is higher under absorption costing than it would be under variable costing. Why? Because part of or portion of fixed manufacturing overhead will be included in the balance sheet and not included in the cost of goods sold. So we subtract less under absorption costing, subtract from the revenue. In variable costing, we subtract all amount of fixed overhead, manufacturing overhead. Under absorption costing, we subtract the part included in the unit sold, while part of fixed manufacturing overhead which are exist in the ending inventory will not be subtracted. However, it will be existed in the balance sheet under inventory. This example will show us how to differentiate between absorption and variable costing, direct materials and direct labor and variable overhead included in manufacturing cost used in variable costing, added fixed overhead, manufacturing cost used in absorption costing. If we have ending inventory, manufacturing costs 7,500, manufacturing cost under variable costing equal 4,500 divided by units produced, because these are the total manufacturing cost, unit produced 100 units per unit cost. In the absorption costing, per unit cost is more than per unit cost under variable costing, because absorption costing included fixed overhead. When we need to calculate the ending inventory, the cost per unit multiply by the ending inventory 20, so value of ending inventory under absorption costing will be 1500, under variable costing 900. The difference, we calculate the difference directly by calculating the fixed overhead included in the ending inventory. So we have fixed overhead 3000 divided total production of 100 units. So the fixed manufacturing overhead per unit equal 30 divided the ending inventory 20 will equal 600, which constitutes the difference between the value in ending inventory. 600 plus 900 equals 1500. This difference equals the difference between income statement under the two approaches or the two methods. So if you are required to calculate the difference between income statement under absorption costing and variable costing approaches, you should calculate fixed manufacturing overhead per unit and multiply the fixed overhead per unit by the ending inventory. Many companies prefer a variable costing for internal reporting. Why? As we had explained, a production manager can increase absorption-based operating income by increasing production, whether there is any customer demand for the additional product or not. The company must also deal with the increased carrying cost related to increase in inventory. This practice, called producing for inventory, can be discouraged or managed by using variable costing for performance reporting and consequent bonus calculation. Again, this figure can show us how variable and absorption costing are different. Manufacturing costs and non-manufacturing costs under both approaches, raw materials, direct materials, variable manufacturing overhead included in the cost of goods sold. However, fixed manufacturing overhead included only under absorption costing. Under absorption costing, including first in work in process, in finished goods, and after the sale, included in the cost of goods sold. Fixed manufacturing overhead and under variable costing included as period expenses under variable costing. Selling and administrative expenses included in the period costs directly. So raw material, direct labor, variable manufacturing overhead included in cost of goods sold and in ending inventory in both approaches. The difference lies in fixed manufacturing overhead. Under absorption costing, it will be included in cost of goods sold and in inventory. Under variable costing, fixed manufacturing overhead included as period expenses. Also, we can differentiate between gross margin and contribution margin. Under absorption costing, sales minus cost of goods sold, which consists of direct materials, direct labor, variable overhead, fixed overhead. Cost of goods sold minus sales equal gross margin. Under variable costing, sales minus variable expenses only, direct materials, direct labor, variable overhead, variable selling and administrative expenses equal contribution margin. Remember, this example show us the difference between operating income is equal the difference in ending inventory under the two methods as we discussed above. Also, this example show us the position or the presentation of fixed manufacturing overhead under variable and absorption costing. Under absorption costing, allocated fixed manufacturing overhead cost included in the cost of goods sold. Under variable costing, subtracted the bottom line from the contribution margin.